Hello everyone and welcome to this review video for the coming examination. We are going to cover those 4 chapters. You can have a look in the material that I have mentioned in the Google Drive. The first chapter that we are going to cover here is the corporate financial analysis of the annual report. The important concept is annual report is one of the official document that the public listed company basically publish once a year, and they provide important informations about their business operations for the past year. So you may need to understand the important and the content and the structure of the annual report. Okay, basically it begins with the chairman letters to provide some message from the top, as well as the overview of the business. They provide the market analysis, market condition about their new projects, about their new movement of the company. More importantly, they provide you the financial statements. So you can have a look in the company financial statement with the annual report, as well as some explanation of those financial statements. So you can see what we are called the management discussion and analysis, or MD&A. The annual report also provide you some information about the corporate governance. How do they govern the company by the board of director? How do they provide the compensations for the executives and the role of those committees? In addition to the financial statement, you can see that the financial statement provide only the numbers. Therefore, they provide some detailed calculation or the detail behind those number in the note to financial statement. And please be remind that note to financial statement is part of the financial statement. They provide you the detail of the auditor report when they prove the accuracy and the fairness of the financial statement. And basically, the auditor's report is the third party that provide the opinion on those financial statements. They provide some detail about the sustainability and CSR activities in the annual report as well. And then you can see that in the first part of the annual report, they provide you some operational highlights to provide some detail at glance of the company. So here is some annual report that we discussed in class. So you can see in reality that basically for the financial analysis, they are going to study or track the development of the company with this document. So this is how we find the annual report in the company step by step. And finally, we recap the importance of the financial statement, including the first one is the financial position or the balance sheet. They let us know about the asset informations, liability, and shareholder equity. So in terms of the asset and liability, we can divide that into the short term and long term. So here is the example of the financial statement. The second statement is the statement of income or statement of profit and loss. They provide you the detail of the revenue, those expenses, and once we use the revenue minus by expenses, we arrive at the net profit. So here is the statement of income for the company called Dusit Thani Public Company Limited. And the last thing is the statement of the cash flow, which consists of the operating, investing, and financing cash flow. So that will be the whole detail of the annual report. Moving on to the next chapter about the financial statement linkage. In this chapter, you must be able to link to understand the structure of the financial statement. You may need to understand the linkage between those financial statements. So if you all remember that we discussed in class, we begin with the income statement first, and then we move on to the statement of financial position. So you will see some practical case and you may need to provide the accurate linkage between those financial statements and provide the accurate answer. So for the financial statement linkage, you can see that in those three financial statements that we discussed earlier, they provide you the different viewpoint of the financial information. And then they have some link each from each to each other financial statement. So the three financial statements, they are interconnected and interdependency. So in this chapter, you may need to prove with the Excel skills to see the result. Income statement is not a cash base. It uses accounting principle. So they use several principles, for example, revenue recognition, matching, or accrual. Okay, so you may have a question that why cash flow you have to add back the depreciation, because the depreciation is the accounting expense. It is not the real expense. So the financial statement for the income statement, they are not the cash based. You may need to understand this concept just in brief, but more importantly, it is important for you to see the financial model. Okay, net income and retained earning. Okay, so once the company they have the net income that will link to the cash flow statement. Okay, and the retained earning will be part of the balance sheet. So this is the connection. That's why we need to complete the income statement first, and then we move on to the balance sheet and statement of the cash flow. So you can have a look here that once we finish off the net earning, okay, if you maintain those net earning to become the retained earning, so that will be the linkage between income statement and balance sheet. Depreciation, once you calculate the income statement, so you have to deduct the depreciation, okay, but depreciation is just an accounting expense. So here is the linkage between this. Working capital, okay, you may need to change them in the current asset. So here is the detail here, but no worry, we move on to the financial statement, okay. In terms of the interest that will be part of the income statement, you pay the interest, okay. So once you repay the debt, so it will affect the balance sheet. So from this point, the most important concept that we are going to move on in this chapter is this financial statement. Okay, so let's look at the financial model in detail here. Okay, so what you have to be careful here is the linkage between this cell. So the case studies will provide you and left some items blank, so you have to complete the table. Okay, so let's move on with the first thing. Okay, income statement. Revenue minus cost of goods sold will be the cost. Will be the gross profit. So you just sum them up. Okay, be careful. This is a negative number, so you need to just sum them up and you just complete like this. So gross profit is mean the revenue minus by cost of goods sold. After that, you deduct selling and general administration and you deduct other expenses, you will arrive at the EBITDA. Okay, you will arrive at the EBITDA. After that, you deduct depreciation. Okay, so you derive them step by step by provide this linkage. And once you deduct EBIT with the interest expense, you will arrive at earning before tax. Okay. And after that, you deduct the tax. So you will arrive at, oh, sorry, this is the total tax. So you should include all tax together. And finally, you arrive at the net income, okay? EBT minus by tax, you will arrive at the net income. Okay, so you derive the income statement one by one, okay? More importantly, you may need to understand the structure of this income statement. So once we finish off with the income statement, like you have a look in the material earlier, we are going to move on with the linkage to the cash flow statement. Okay. So the net income here, okay, you just link with the cash from operation. You have a look here. Okay. However, depreciation and deferred tax, you didn't pay it out with the cash. Okay, so you have to add them back. You have to add them back. The way to add them back is it is equal to minus by this one. Okay, so you are going to change them to the positive number. The same thing as the deferred tax. You do the same thing here. So right now you complete this thing. When you see the word subtotal, it means you sum them up all of the item in that subsection. So right now you arrive at the subtotal. So here is the cash from operation. So you can have a look with the solution here as well. So let's move on. If you all remember, when we look at the cash flow statement, we divide them into OI and F. So we finish operating cash flow. The next thing is the investing cash flow. Okay, we have only one item here. Therefore, you just equal to the capital expenditure. And finally, for the financing cash flow, it is a sum of this thing. So you arrive at the financing cash flow. Okay. When you scroll down, you can see that the beginning cash in the pocket at the beginning of the year is 5,000. Change in cash is mean you sum O, I, and F together. Okay, so it means that at the beginning of the year, you have 5,000 in your pocket. And throughout the year, your cash increased 6,000. Okay, so by the end of the year, that will be 11,000. So the ending cash of the previous year will be the beginning cash for the following year. And then you do the same thing for the change in cash. Okay, and you sum them up. So you are going to arrive at the end of the year. And this cash will be the beginning of the following year. And finally, you will arrive at the ending cash by the third year. Okay, so this is how we work with the financial statement and how we link between our income statement and the cash flow statement. So moving on to the third chapter about the project's valuation. If you all remember, in this chapter, we apply financial feasibility canvas as well as our financial model. So you must be able to understand the concept on how we derive those cash flow as well as how to answer the investment decision by using the financial feasibility canvas. So project valuation refer to the valuation of some investment projects because you are going to commit your long-term resources with those projects. So if you all remember, we are going to use the financial returns calculation to justify whether the investment is good or not. So we must be identify the net present value to identify the value created by the business. And here is the decision criteria as well as the internal rate of return or the discount rate that bring the NPV to 0. And if the IRR is more than the discount rate, so we should accept these projects. And for the profitability index will help you to calculate the benefits to cost ratio. And if the PI is more than 1, it means that the projects add values. And finally is the payback period. So to do that, we apply the approach of the financial feasibility canvas. So in the exam, you will see the case studies and you have to answer with the financial feasibility canvas in the answer sheet. So we begin with the first step about the investment rationale. So we must have a clear rationale why you are going to do this business. You have to conclude the attractiveness of these opportunities in a small building block so the audience will understand them pretty easy. The second step is about to is about to estimate the capital investment. So be careful that the capital investment is two part. The first part is the fixed asset and the second part is the working capital. So you have to see in the financial model, they will have some part that calculate the working capital for you. The third step is the assumptions. And if you all remember, we use the financial model and those cells, we put the yellow colors so you can adjust the number according to the case studies. You may need to conclude the those assumptions in a small building block to let your reader understand them easy. And then the fourth step is the cash flow calculation. Don't forget that we have to look at the free cash flow. Okay, we have to use the free cash flow. We should not use the net income. So you may need to review the model. So you provide a cash flow from year 0, year 1 until year 5. This is a 5 years financial model. We assume that the business that you are going to do will be 5 years long. And then after that, don't forget that in year 0 is mean your initial investment. Okay, year 0 is mean your initial investment. After that, the Excel model will calculate the financial returns to you. So you have to let them know in the fifth building block here under the financial returns. And finally, you have to make a decision in the last building block that will you accept this investment or not. So if the NPV is a positive number, AI is more than the required rate of return, PI is more than 1. So yes, we can accept these projects. So let's have a look in this financial model, and you can see that in the yellow cell here, there are our assumptions. Okay, so you have to think about the product. If you have the product A, B, and C, for examples, and if you have author's revenue, you have to put it here. Okay, but if you have only one product, just make it like this. So we have only one product. So this is the estimate sales volume, and be careful that this is an annual basis. This is your selling price and this is your cost of product. After that, this is your investment, okay, in fixed asset or capital expenditure, and this is your selling and general administration. So you scroll down. In this row, we'll provide you the cash flow from year 0, year 1, year 2, year 3, and year 4. And again, this is the calculation of your working capital. So in the second building block of the financial feasibility canvas, you have to let the audience know that this is your initial investment plus with this one. Okay, this one is the working capital. And here is the financial returns. Okay, so when the number is like this, okay, we can accept these projects. So you must be able to understand the financial model and be able to apply them with the real case studies. Then moving on with the last chapter about the risk management, sensitivity analysis, and scenario analysis. In this chapter, okay, it is important because if you all remember in the yellow cells that you see in the earlier chapter, you assume them. Okay, so how we can ensure that those number is accurate or we can rely on those number. And the fact is that all of the forecasting, they are always wrong. Okay, we cannot estimate those number precisely. That's why revenue assumption, cost assumption, capital expenditure, those financial assumption can be varied. So we are in this chapter, we are going to use the Excel function to see the variation of those assumptions and how do they affect the financial returns. So how we can verify the accuracy of this yellow cell? So we need to vary them and see the effect. If you vary some of them and then they bring the NPV to zero easily, so we can say that that assumption is very sensitive. So the variation can come from several points in your financial model. For example, the revenue assumptions. Okay. In fact, you might sell more than what you have planned, or you might sell less than what you have planned. Also, with the cost assumption in the same way and the capital expenditure, it might be larger or it might be smaller than what you have planned. Financial assumptions, economic factor, regulatory environments that will bring some variation to those yellow cells. Therefore, based on the financial analyst skill, we have to do the sensitivity analysis and scenario analysis. So be careful about the difference between the sensitivity and scenario analysis. It means that when you look at the sensitivity analysis, it means you are going to vary only one assumptions at the same time. But when you look at the scenario analysis, you are going to vary two variable or more at the same time. So the way is to identify the variable and you vary them and you see the results. Let me share you with the financial model later. So here is the result, okay? I'm going to show you with the result and then I'm going to ask you to analyze this, okay? So this is the NPV, okay? This is the NPV. This is the NPV and this is the IRR, okay? This is the IRR. So you can see that we are going to vary the fixed asset investment. 100% is mean 100% according to the plan. So if the investment in the fixed asset grow up 10%, 20%, 30%. So you could, this sensitivity could be implied that if the fixed asset investment grow more than 20% according to the plan, so that will bring the NPV less than zero. It means that if you go beyond this assumption, it means that this project should not be invested or it won't create the value for the shareholder. Okay, so you must be able to interpret the meaning of this sensitivity analysis table. Also, here, okay, in this table, we talk about the variation in terms of the fixed asset investment. And here is the variation in terms of the revenue. Okay. About this is mean no IRR. Okay. We cannot calculate IRR this because it is too small. Also, we move on with the scenario analysis. It means that you are going to vary more than one assumptions. Okay. So here is the solution. Okay. You vary the fixed asset investment and you vary the revenue at the same time by the NPV, by the IRR. Okay. So how to interpret the meaning? For example, this one. Okay. For example, this one. What is it? Investment in fixed asset grow more than 20%, while the revenue you can maintain at 100%. Okay, so that will be a scenario. What happened to here? Okay, what happened to here? Minus 889 is mean, oh, even you can save the investment in the fixed asset, but your revenue drop more than 10%. That will affect the projects to the negative NPV. So you must be able to interpret the meaning. Okay. We can say that we have the base case scenario, okay, base case scenario, worst case scenario, and most likely scenario. So what happened? Okay, if you have a look here, when you see 100% here, 100% here, is this the most likely? Okay, this is the worst case, and this is the base case, you see, and this is the most likely case. So you must be able to interpret the meaning of this outcome from the scenario analysis. Okay, so later on after this, let's have a look on the application of the financial model. So here is our financial model, and if you have a look here, it is the same model as we did in the earlier examples. So right now, we are going to look at the risk management and the sensitivity and scenario analysis. Okay. So we put the assumptions here. Okay. However, be careful. I put some dummy cell here. Okay. So we are going to vary the number with these cells. So you can have a look at the initial case. We say is that the investment is 12 million. However, in reality, the investment might be 100%. It might be 110%. You see, it might be 90%. Okay. So I create one cell here and I put 100. And the linkage is here, capital expenditure in the year 0. You can see that I use the most likely investment here and multiply with this cell, 100%. And I put it here, you see. So if I change to 90%, it will affect the initial investment here directly. And if I change to 110%, it will affect this directly. So this cell will help for the sensitivity analysis. You see. Again, what happened? In terms of the revenue, I sum them up from the revenue here, and then I use this cell to vary them, okay? If I put 90%, it means that the revenue dropped 10%. And if I put 110, it means that the revenue increased 10%. I do the same thing with the cost of goods sold, and I do the same thing with the selling and general administrations. So every cell here will link with this one. So we are going to move on with the sensitivity analysis here. Okay. So I just draw the table, put 100%, 110%, 120%, 130%, and 140%. Okay. Let me put it like this by the formula. Okay, so you can see, 90%, 80%, 70%, and 60%. So this will be the possible range in terms of the variation in terms of the fixed asset investment. So we are going to do the sensitivity with the NPV. So be careful, link this cell, okay, to your NPV. And then you select all the area here. You go to data, you go to what if analysis, you go to data table. Right now, we are going to change the investment. Okay, so don't forget that we use this cell L26 to vary your initial investment. You just click OK. So once you click OK, they will simulate the possible NPV once you change the fixed asset investment. So you can see that the area here will provide you the negative number. To make it easier for the reader, you select this, okay? You go to home, you go to conditional format, highlight cell with the rule less than, you put 0. You put 0. So when you put it like this, it will help you to highlight the cells with the negative number. So you can, the reader will see this easily. After that, we do the same thing with the next table here. We are going to analyze sensitivity on the IRR. So you select IRR. Okay, IRR. So the first table here is the NPV, and the second table here is about your IRR. You do the same thing. Select the area here. Okay, can you remember? Data, what if analysis, and data table. Right now, we are going to vary your initial investment. So in the row input, you click here, you click OK. So what you are going to do here is that you got IRR from several cases. Okay. The way to do the highlight here, the same thing. You select the area here and you go to home, conditional format, highlight less than. But be careful. Okay, be careful. When you calculate the IRR, if the IRR is less than your discount rate, so you have to click on the discount rate and click OK. Based on this way, you see, you will know that, if the investment go more than 20% like this, we should not invest in this project. So let's practice together with the case of the revenue. Right now, you are going to do the sensitivity analysis on the revenue. Click the same thing, okay? And you click the same thing to the IRR, okay? So right now, everyone, we are going to vary in the second table here, and we are going to see the sensitivity on the revenue. So if the revenue go up or the revenue goes down, you select the area here, you go to the data, what if analysis data table. Right now, you are going to vary the revenue. So you click on L36. You click OK, you see. You see. So if the revenue goes down, okay, if the revenue goes down, the NPV will be negative number. You do the same thing, okay? Maybe you can practice it at home, okay? Data, and you click on the revenue here, okay? You can see that right now. This table let you know about the sensitivity. You do the same thing, home, conditional format, less than zero, less than zero. So they provide you the area here, okay? Same thing, okay? Conditional format, less than, and you click on your discount rate. So you will arrive at the highlight, okay? What happened to here, okay? Around here is mean IR, you cannot find IR here, okay? It is not, IR is not available here. So let's move on to the sorry, let's move on to the scenario analysis. We need to paste spatial and put on transpose, and you have to copy here, you put it here. Okay, you do the same thing to set up the table. Okay, right now, if you have a look here, it means that we are going to vary two assumptions at the same time. We are going to vary the investment together with the revenue. Okay, so we move on with the NPV. Okay, we move on with the NPV. It is equal to, oh, be careful. It is equal to your NPV here. And it is equal to your IRR here. Okay. Change them to percent. So right now, everyone, we are going to do the data table for the fixed asset investment and revenue. You go to the same thing, data, what if analysis, data table. You are going to vary your investment as well as your revenue here. You see? So they provide you a table with several scenarios. You do the same thing. What if analysis, data table, okay? Fixed asset investment, revenue here. So they come up with the IRR. You see? You just change the format to the percent. So they're going to show you in terms of the percent. You do the same thing to be like a professional financial people. Conditional format, less than zero. Less than zero. Less than zero. So they will highlight. So be careful about the scenario in the red cell. So that will bring you the negative NPV. Move on to the IRR. You see the same thing, okay? Less than your discount rate. Your discount rate. Right now, your discount rate is 12%. So this is your scenario analysis. So you can see, if you can see the relationship, it means that the red area here and the red area here must be the same. However, in the first two rows here, IR is not available. Now it is not available. So the goal here is that if you see the table like this, you must be able to interpret the meaning. Oh, Ajahn, this one should be careful. This one should be careful. You see, for example. So this will be the review video that you must be it should be important for you for the coming exam. So this is my review video, and then good luck for your coming midterm examination.